So if I look at a daily chart, what we're trying to do is ascertain the likelihood of it being a up close or a down close day. So I like to look for intermediate term and short term highs and intermediate term or short term lows. And what I have here is I have this high delineated and I have this low, these highs up here, this low. Now I teach that when the market's not in a trending model and or a parabolic move up or down, the market's going to work off of traditional support and resistance theory. Now the problem is which support and resistance do we use? So I look for the key turning points, the real obvious ones. Now, you can use these short-term ones in here, but the main one is here because the market moved from that low all the way up to this high, consolidated, tried one more time to go higher, failed, went lower. Found some support here, found resistance, found support, tried one more time, failure, the market moved higher. So we're looking at the ebb and flow of how the market moves from a point of overbought to oversold to equilibrium and consolidation, and a new move that would take us to an overbought or oversold condition. That's a range-bound market. The first thing I look for is, are we coming off of a run above an old high that may see it trade back below it, or are we trading below an old low that may see it trade back above it? What I do is I look for these intermediate term price points and swing highs and swing lows on the daily to see if we have moved above an old high, because we could very easily reject that and trade lower, or if we trade below an old low, we could see it come back above it and stay inside the previous determined range. So if we look for candles or daily ranges that run above an old high, chances are we could see it continue going higher, but we also have to be mindful that we could see an eventual turnaround or reversal, and it could start to go back below that old high, because this could be very easily seen as a false break. Same way with the old lows, as we see here, the market does in fact trade through it, tries to make a lower low, couldn't do it, failed again, and then started to trade higher. So we have to have these intermediate term swing points on our daily chart because they're going to be potential reversal points, failing to follow through after breaking an old high or breaking resistance, or failing to make a lower low and trend lower after breaking below old support. So when the market's not trending, this is the scenario that it will typically trade within. The market trades below these lows in here, can't rally above, and collapses, trades below. It reprices all the way down below an old low, and then rejects, comes back into an area of consolidation, then rejects again, expansion, lower, finds a low, cannot find momentum through it, consolidates around it, tries one more time to go lower, then trades higher. Every time the market breaks a swing high, and if we look to the left of that swing high, where's the next old intermediate term high? This one here. So there's nothing for it to potentially reverse inside of until we get up to here. Once we clear this high here, what's the bias? Well, if you look at this little diagram I have over here, this is going to refer to the previous day. Now, this could be a bullish or bearish day. It doesn't make a difference. But when the market is bullish, as we've outlined it over here, we're going to be looking for the previous day's high to be the target and the previous day's low to be supported. In other words, there shouldn't be any movement below the previous day's low. It should all focus on the buy side. It means reaching for the previous day's high. When the market's bearish, this scenario would be reversed. We would be looking for price having an inability to get above the previous day's high and to seek the previous day's low. Using this criteria here, okay, once we broke this candle's swing high here, the daily bias on this candle, and this is a Sunday, we would look for Monday as well, and then Tuesday we would look for bullishness. This particular candle right here is the one that broke the swing high, and then we know they have a resistance level it could probably reach for, so we're going to be looking for the next day to trade not to the previous day's low, but to and through previous day's high. So this next day, what's the daily bias? Here's the opening. It's going to want to reach for this high, so where's it wanting to go? Up. So what are we going to focus on? Previous day's high, because it's bullish, it's wanting to go higher. Now we have yesterday, this is what this on this candle's date. Market opens, and we're going to see it trade through that. And with the anticipation, it's going to eventually try to reach for this daily high. The market closes in the middle of the range. Here is Sunday's trading. Then Monday, the same phenomenon. You would look for the market to want to trade through what? On Monday, we would look for this previous Friday's low to be supported, and we would look for price to run through previous Friday's high. Monday, we see it open here, a little bit of movement above it, but it does in fact pierce Friday's low, and it comes back and closes where it opens. So is there any significant change in the underlying direction? No. Did we trade to this high yet? No. So we take that same premise and we see it open here. So what's the bias? We're looking for the previous day's high. Why? Because we have yet to trade back to this old resistance level. Market opens here, trades up, trades through it, but look what it does. It comes right back inside the daily range. But as we're reaching for these intermediate term levels on the daily chart, we're factoring in, does it have enough range to reach for it above or below? And then we take that approach and apply it immediately to the previous day's high and low, as we have here. And what you're determining is if we're bullish, we're going to be focusing on the previous day's high for momentum. And when we're bearish, bullish, we're going to focus on the previous day's low for momentum. Very rarely do you see both sides of the previous day's candle tagged or traded through. If it does, it's usually indecisiveness or it's going to be a reversal soon and they're clearing the board on both sides of the marketplace. And when you start seeing those types of things, get prepared because the market could be in fact about to reverse. You can see that actually happening here. Previous day's high and low here. The next day it trades through it and its low is violated too. So we're about to see a reversal. Next day, reversal. This is called an outside day when you have a previous day's range that's violated with the well, this is an example of it too. This high is 93.98 and the low is 93.67. This candle's low is 93.58 and the high is 93.99. So this is an outside day with a down close. That's typically bullish. Reason why it creates a false break above the previous day's high and then closes on the low. If we're in a bullish market overall and that occurs, generally sends up a really good buy scenario. But you have to have a context behind it. You can't just take an outside day with a down close and just naturally assume it's going to be a bullish day. And my application of outside day is when it does that, it sets up a potential short-term reversal. Here's another scenario here, outside day. We have the candle here, and then we can see the market does in fact want to trade higher as a result. So you won't always get the outside day at turning points, but I like to look for it because it builds a lot of confidence behind it. And by using these tools, okay, and when the market also breaks more or less a swing high of importance, and we have a level that doesn't have anything else until we get to here, it's bullish. Avoid this whole scenario like looking at this high to this low, pulling fibs on, looking for optimal trade entry, and sell off and all that stuff. It's already shown a willingness to want to go below this low multiple times, and then it broke a swing high. So the momentum is bullish, and that's going to reach for this.